Hi, I'm John Gatewood, founder and CEO of Gatewood Wealth Solutions, where we are on a mission to help individuals and families become and remain financially self-reliant. Welcome back to our weekly Market Insight broadcast, where we give you our perspective on the week's top news stories regarding the market, the economy, and your portfolios, so that we can keep you better informed when making decisions about your money. Welcome back to our Chief Investment Officer, Aaron Tuttle. Thanks for coming back and being with us again today.
John, I'm glad to be here.
It's always good to have you here.
Yeah,
Because I know you have a lot more information than what I have.
I would say the same thing, but I really enjoy Chris.
Chris is a pretty good commentator as well. So he may be replacing me at some point if I don't get my act together.
Nonsense, nonsense. You're the boss.
Well, I keep hearing the word inflation.
Yes.
And then I also hear about government spending going up.
Yeah, they're probably related.
Well, in fact, tonight, President Biden is going to be speaking to Congress, and he's going to talk about his $1.9 trillion or $1.8 trillion spending bill and how we're going to pay for it. So let's get into that.
Right. Let's just jump through our forecasts and then look at that government total expenditures. So we can see it's almost a hockey stick, but we've certainly had the problem of spending all the way up until the previous year too. But yeah, no, the amount of government spending here recently has been very high. Now we have two of those stimulus bills, infrastructure bill and also an additional stimulus bill, both very big ticket items. Whenever we were in the 2008 crisis, everyone was very upset, myself included, and still think justified, on the $1 trillion that was spent for the bailout. And here we're doing $2 trillion spending. So government spending is certainly high, and we're starting to see that show up in the reports for companies. So this is looking at inflation concerns whenever the earnings reports are coming out for the companies, and we can see that there is a correlation, and that makes sense, that companies begin to report on inflation whenever they're giving their updates on the goods and services and materials and labor and all the things that they're spending, and it correlates with CPI, and we can see that it's up 12%.
That's enormous.
Right. And
well, we were talking about last week, remember that Procter & Gamble announced that they're going to raise the prices on all their consumer goods coming this September.
Coca-Cola is raising their prices?
This is just the beginning.
Yes, it is very much the beginning.
And one of the things that we've been talking about as economists is the fact that when you increase the money supply through government spending and otherwise, that this is a form of inflation. You're creating more dollars to chase the same number of goods.
Right. If you don't increase the amount of goods at the same rate and there's no demand to hold additional cash in your balance, then you will see prices on those goods rise.
Well, the last 2 days, the Fed has been meeting about its policies going forward, and they're going to keep the rates near zero.
Right.
Do we think that they understand this or are aware of the inflation concern in the way that we see it, and as we're beginning to hear out in the mainstream media?
Well, I can't go in there and read their minds. So it seems to be pretty well established, but we've had this recent decade that they're pointing to where they actually have said that monetary policy has no really importance or anything worth paying attention to, especially when it comes to inflation. And the whole purpose of the Fed is to manage the money supply. How can they say that? But we are seeing an uptick in the concerns by companies, a substantial one, and we can see the CPI tends to correlate with this. Now we are seeing an increase in the CPI when we just look at the measure for consumer products, but we've been as high as this before. Granted, we did not go negative in the previous recession from the lockdowns, so we're going off of a higher base, and we're already well above that target inflation of 2%. Now the Fed has changed their goal. They want it to average 2% over long term, so they're going to allow it to overshoot. Whether we see.
So where does it seem to be going at this point?
So right now, when we're seeing it in the actual producer pricing. So
the producers are the ones that are getting hit first, essentially.
So this is just a snippet of several of the reports from different companies, and they're all talking about significant price increases as they produce the product. And a lot of this is supply and demand. So if we look at the import price, which is a major part, we can see a much higher spike relative to the CPI. The CPI is the blue line, and it's going parabolic. Now, it's gone parabolic before. We're also seeing it in just the producer price index. So as the companies push those out, which is if they can push out the price, then stock prices will continue to move up. So that's a good thing if you are an equity investor, or at least it helps you maintain your purchasing power by owning equities, because that.
How likely is that to happen going forward?
We think that this is all, at the moment, it's transitory. So this is the gas price. We can see that that's gone up. But if we look at what's actually causing the current issues, it probably is transitory at the moment. There are many ways.
When you say transitory, tell the audience what
short
you mean
term.
by
So
that.
it's not going to be a long-term component. We just see a rise in price, and then at least the rise slows or is no longer there, and it can actually pull back. And if we look at just how many ships are trying to get into ports because you're trying to back order all these goods, I've seen reports of people paying $15,000 per shipping container. That's incredibly expensive. There is this supply component. There's also a demand component, because a lot of people have done without and they're trying to restock. And we talked about this last year, that we would get to this situation where there wouldn't be much supply and there would be significant demand, especially since unemployment benefits oftentimes are higher than many people that are on the lower wage. So we're actually paying people to stay home. Well, then they have money to use for consumption, though the actual production, the business isn't necessarily producing as much. And there was in the headlines, I saw a Tampa McDonald's that would pay you $50 just to show up for an interview. And there's labor, though unemployment is high, we see this labor shortage, especially in the lower wages across the board.
Looking at the supply chain, because that was disrupted as a result of the pandemic, do we see this fixing itself over time?
So that's what we're saying is transitory. The supply-demand will come to a balance. Prices will increase. That will cause people to demand less because it's more expensive, and then they will finally settle. So that is transitory. And we have the monetary policy. Where it's probably not going to be transitory, and where we're going to see it most is going to be in food prices. And we're seeing food prices go up substantially. So you're going to see it on
Why food prices and not others?
Because as prices go up, whether you're high income, middle income, or low income, usually the dollars that you're going to spend first is going to be spending on food. And there's also, if you don't have enough money to meet those demands, we have government programs to help demand stay high there. So we'll see that likely in the grocery stores before we see anything. But there is this discretionary component for the low middle income, where if prices are going up on the things that they're demanding and they have to use more of their paycheck to purchase these items, and they have less of their paycheck to pay for other items. So that inflation, and we've talked about this a lot, is everyone's basket is different, so everyone's inflation experience is different. And we can start to look at different groups on how inflation affects them differently. And if we look at the bottom 10% and the median earner, we can see inflation is much higher than if we're looking at the top 10% of earners. So they may see an increase in their food price, but if it's not as big as percentage and everyone else has had to cut back elsewhere, then they get to, the higher income will actually be able to spend money and have it go further for them in the goods that are not as demanded because inflation is moving prices up. Am I making sense?
Hey, yeah, let me just play that back. So what you're saying is that inflation is going to affect different people, or affect people differently. So the people that are at the lower income scale are going to be much more affected by inflation because it's the primary goods that they buy.
Yes.
Gas, they buy food. So those are the things where we're going to see the highest inflation and eat up more of their paycheck. And what may result is, I guess, would be that they may look to substitute those goods for lower quality just so that they have more money to continue. But if the wealthier you are, the smaller an impact of those types of inflation effects have on that individual.
So without the substitution, if you have to spend more money on hamburger, you have less money to spend on jeans. So then the jeans prices go down. If you have plenty of discretionary income after you've paid for your groceries, you're looking at jeans and you're actually getting a bargain. Because you're in the higher income, you have that excess cash to buy the things that are not actually demanded, since most of the demand is now being consumed by groceries and other goods.
Looking at the inflation then going forward, how long or sustainable will this increase be?
So the transitory, the supply or the base inflation should be 6 months, 12 months, no longer than that.
So it's kind of going to be a shock, for example.
Yes.
So for a lot of people, when they go to the grocery store, they buy their basic goods, they're going to all of a sudden find that things are much more expensive than they thought.
But then there's the other component of we're still expanding the money supply, we're still expanding government spending, and that can continue to have inflation. And ultimately, that's a monetary inflation that we see, not so much the supply-demand bottlenecks. And that could be more prolonged, especially if that changes in people's mindset that prices are more likely to be much higher in the future than they are in present. And I'd actually do better to spend down some of my cash balance now to get the price to prevent the price increase later. So that'll put further inflation, and people are actually losing faith in the currency holding its value. And that's the final part of inflation that can be very prolonged, and it's very difficult to actually stop. We had to go to 20% interest rates in the early 80s to try to stop that inflation that was experienced in the 70s, because the mindset, the psychology of the buyer had changed. So that would be the long-term inflation that could
What I see
be
here
possible.
then is really a social problem that this is going to create, because in essence your asset prices are the things that are going to be going up, and it's the people that hold the assets. Well, most people that hold the assets are the wealthy people, which means that the people that are not able to have assets are going to see their incomes be be eaten up by the higher cost of goods, and not be able to save the way that they would want.
Yes, well, there's also going to be political unrest, which will support calls for higher taxes on higher income earners. Now, this is not a phenomenon that just happened in 2020. This is a phenomenon that's been going on for quite some time. We've made the argument that it's been the Federal Reserve and their monetary policy that has really benefited people with assets over those that make income. So that 1% and that big divide between the different economic levels is something that's been prolonged, and we say the blame falls on the Federal Reserve.
How does that balance against this, for example, tax increases?
So there's the people that are in the top 10% look like they, and probably are, having more and more of the share of consumable goods in their lifestyle is expanding, while the people at the bottom 10% are really feeling it. So then it's easier to propose higher tax increases. So the current tax plan that's built into the infrastructure spending and the other bill, I can't remember the name of the two, is one, to raise the corporate tax rate from 21 to 28%. Restore top individual rates from 37 to 39.6%, and subject wages above $400,000 to Social Security payroll tax. So not only do we get a higher margin, but if you're at that high margin, you'll have an additional 13% for payroll tax added to your tax. And as the one that we're most concerned about is taxes on capital gains as ordinary income, as well as trying to fix the issue that you would have with estate and the death tax and the step-up basis on what that would, the actions that would cause an individual to just never sell a stock.
First of all, what is the likelihood that this will actually go through? Do we have any feel for that?
Well, both of these bills seem to be losing momentum. And the senator you really have to pay attention to is Senator Manchin in West Virginia, and he has continued to push back against these ideas, as well as push back against the filibuster. They're also using a procedural rule of reconciliation. Historically, that reconciliation should only be used once on the budget a year, so they'd be reusing it, but they're saying they're reconciling the reconciliation. And the person that oversees the rules, the parliamentarian, has given them the okay to do the reconciliation of the reconciliation. So it really is going to be about Senator Manchin, and a lot of this, I think, would affect his constituencies or his constituents. So it's not a very high probability. But but I also wouldn't say it's non-existent either. It's just trying to tweak things to get enough people to move forward because they only need the 50 votes plus the vice president tie-breaking.
I know we're going to talk about the impact of the higher capital gains rates, but one of the things that strikes me here is looking at the FICA tax, the Social Security tax being added to wage earners above 400,000, because now you're going from the 39.5 or 6%, adding another 13%. So you're really creating you're increasing the tax to 44%.
Yes.
That's a much higher rate than most people realize, I think.
And then if we throw in states like New York or California, you're in the 60, and with the payroll tax, possibly 70% tax on additional income. A lot of people will stop working at that threshold because they're getting so little money remaining for any additional work that they would stop working at that point. And we saw this before this happened. That was one of the things that Reagan had talked about and campaigned about on the higher tax thresholds at that time.
Well, it's interesting because those are the states that want to have the SALT deductions back, where they can deduct their state, local taxes on their tax filings so that they can have a better tax effect. But this actually is going to go against that.
Yeah, so I would not be surprised, since so far we've been able to basically print money and there's not been the inflationary effect of that. And if that continues on, why raise the taxes? So I wouldn't be shocked to see all we end up is a tax cut, where the blue states, because that's who have the higher taxes, would get the higher tax break and the tax cut, and they're the ones in power. All this being said, even if this was to pass, it's not that this is going to solve all the problems either, because it may not really impact the amount of government receipts coming in. People do change their behavior. There's a proposal to have the IRS give them $88 billion over the next 10 years to try to make sure people are not gaming the tax system. Well, if you have to pay people to prevent any additional gaming of the system, additional money, one, that's money that you're not going to be able to spend on the other government items, and two, it proves the point that, well, people are going to do a lot of things to prevent the tax from actually hitting them.
Right, just by spending the $80 billion and trying to come up with more people to go and do audits, that's not going to prevent people from going and gaming the system. And
though this is a higher than average tax increase, if we look at both of them together, it's not the highest. And it's funny because you hear this tax this tax increase is one of the highest ever. It's going to kill everything. And at the same time, you have people say, but it'll have no effect because of what I just said.
Right.
And it comes out of the same person. Both are essentially true. You can have a high tax increase and actually not have. And if we look at
there's a viable reason for either of those arguments.
Right. You're not logically inconsistent, even though it sounds like you are whenever you're saying those, but it does make you scratch your head. If we look at the Congressional Budget Office on their estimates, we would see tax increase, the revenue come back to rates that were similar to the mid to late 90s. So the economy has been there. But whenever you're talking about such substantial increases where your 15 to 20% capital gains treatment is now up into the 60s and 70s if you're in a California or New York, 50s and 60s, sorry, they wouldn't have the FICA tax there, then there's going to be a lot of people not.
There'll be ways to game the system because everybody's going to find a way to lower their tax bill.
Absolutely, absolutely. So the actual estimate is probably a little bit higher. In addition, it does slow the growth of the economy.
Let's talk about this, because I would assume that this is going to have an impact on our views of the market going forward, too.
So if we look at Tax Foundation, which is a think tank, and it's supposed to be nonpartisan, if that's possible, but they are respected. Gross domestic product, they would assume, would slow 1.6. We would drop 1.62% on our future growth. Our capital stock.
So when you're saying that it's 1.62% below what's currently being projected.
So if you're at 3%, you're now down in the 1.
Yeah, so we're not all of a sudden having a negative GDP. It's just that it's going to be a slower growth.
Correct. And then capital stock, we would, because the cost of capital with the tax, people would put less money into the stock market, so that the amount of capital would actually decrease. And it's that capital that actually allows for wage increases long term. The better and more efficient your tools are that make you more productive, the more you can sell, and the higher wages you can pay. So we would actually see a wage rate drop because of that tax increase. So it's not just the wealthy that are going to feel this. It's the wealthy that create the businesses and spend a lot of the money. So if they have less of that to do, then it will affect the employment of people that they hire. And then that would cause an estimated half a million lost jobs based on just having those tax increases go through.
Looking at our capital market assumptions, in other words, of what we expect the returns to be going forward, would that mean that we would foresee or forecast lower returns?
Not necessarily.
So tell me more about that.
I'll get to that, but I wanted to do one last component, which is talking about tax revenue as a way to close the gap. We can change the way taxes are received, but that's not the problem. The problem is the amount of government spending. And what I'm doing is here with this shape is just trying to show you the volatility and the growth rate compared to revenue. Revenue is actually fairly steady. It continues to move up. It does go up and down depending on the economic cycle and the tax policy.
But it's still fairly consistent.
It's fairly consistent because a drop in tax rates can increase the growth of the economy, and you end up with similar. I don't think that you necessarily get more. I'm not a big Laffer curve proponent. My guess is that the government would actually bring in more revenue if we did a tax increase, so I'm not making the Laffer curve here. But when we just remove that graph, we can see here's the revenue and the stability of it, the green line, versus the spending. We can see the spending is what's growing, and if we were to look back here at the bottom, we can see the deficit. So it's really this government spending that is causing a lot of the problems. Now, people will advocate that we need to do that to get the economy to grow faster, and there is some truth to that. So I'm not making a political component. I'm just saying that it's really the government. If we want to make a big impact on the deficit, the bigger thing to focus on at the moment is government spending.
All we're trying to do is to figure out what this is going to mean to the market.
Right.
This is not about a political statement. It's knowing what's going to potentially happen. What do we see the returns going forward for our clients?
And so then the fear is that if we have a capital gains tax increase on stocks, that we're going to have a market sell-off.
Well, that would certainly seem to be what most people would think.
It can happen, but if we look back in 2013, 1987, taxes were still fairly low relative to historical periods, and they did move them up, and we can see that 3 months before, 3 months after, 6, 12 months, you had positive returns. And then if we look back in 76, which is rates that would end up being closer to what is being proposed, there were some negative years over the next 12 months, but then it continued to move up. The 70s was a rough decade. So it's not to say that there isn't any precedent in it, but more likely than not, we'll actually see the stock market move up, at least after maybe a quick pullback, and it won't be too much. And the reason is because if the capital gains tax moves up and it's high, it costs you more to sell your position. So you're not going to sell it. Why would you take a 40 to 50% hit against your capital gains? The investment opportunity to leave that stock to go elsewhere has got to be pretty substantial to make up that gain. So people quit selling shares.
Would you see people all of a sudden selling shares before the end of the year in which that takes effect?
There are different strategies that will be employed, but for overall, most of the stocks will actually be removed from trading and will just be held long term. Well, that means that there's only a certain amount of stocks that are left to trade. And if there's similar money, even if it was a slight pullback, but the amount of stock that really comes off the market as tradable stocks, you have the supply of trading stock lower, or the kind of the float, and you still have a lot of money coming into that, and they will bid up the prices. So what you have is not a market that is pulling back or selling off. You have basically more money chasing that stock. You have a market that's appreciating because the cost, and it's less efficient. So
if I hear what you're saying, if we have a higher capital gains rate, long-term capital gains rate, that won't necessarily make the stock market go down in value or have lower growth in terms of the asset prices. What about the income tax effect?
Well, the income tax effect is what's going to cause so much of this stock to not trade. Meaning that if there were, in volume, 1 million shares traded, now those shares are not going to be there, so maybe there's only 200,000 shares traded.
So when the government's doing their forecast, are they also taking this into consideration?
So there
may not actually be collecting as much in taxes.
That's absolutely right. That's the reason that you rarely get the projections that are estimated, because if you were getting, let's say, $1 trillion in capital gains, which is way over let's say it's 180 billion in income tax, and then you double that, you're not going to get 360. You're going to have a lot of people that are not going to do it. But the supply-demand metrics on the market for the stocks that are trading means that there are less stocks trading and a lot of money still chasing those fewer stocks, so that pushes the price of stocks up. And it actually pushes it up, so it is trying to equalize the after-tax effect of the tax gain, so the people that it would finally compel people to finally trade whenever they're getting their after-tax number. So you can see sense. Stocks actually appreciate. We saw this in the 1920s. They came in and put a capital gains tax that was fairly high on stocks. Very few traded, so we actually saw an appreciating market. What the cost is an efficient market. You no longer have stocks trading to the price that fundamentally that they are, because if you sell your stock because you believe it's overvalued and you lose half of your gain because of it, you're like, well, I'll just keep the stock.
Right.
So it's not necessarily going to cause the market to sell off. But what strategies would we use?
What would we use?
One, clients, especially if this is passed, will see exchange-traded funds in their portfolios more often because of the way that they can structure their capital gains distributions. They don't have to send them out as capital gains distributions. There's ways behind the scenes to distribute the funds that doesn't cause a person that's holding the fund to have to pay capital gains tax that year.
So you're saying that in our client portfolios, would they see more of the exchange-traded funds?
Yes, and there's active funds now. So it's no longer just you got to take a passive strategy. You can find active ETFs.
Right, so we would still be following our same momentum strategy
yes.
in this, but it's just that we'll be using more of these types of securities simply because of the tax effect.
They're more tax efficient than mutual funds. And we think long term, most mutual funds will eventually go to an exchange-traded fund construction, because it favors the ability to distribute without having to do capital gains distributions pass through. Coffee can portfolio. Now this is an approach that many people.
Does that mean I'm putting cash in my coffee can?
That's what it's trying to.
Put it over here.
That's what it's trying to.
Until I come get it later.
That's what it's trying to make you think about. But it's actually a fairly wise approach, which is you do deep research on the buy side of the stock, and you're looking for stocks that would have a good bright future but are trading well below on a discounted value, knowing that you can't or unlikely are going to make money on the sell side. It's got to be all on the buy side. So you begin to focus on those buy side, and it's a stock that you believe you can hold basically forever. It's not a stock certificate, it's a marriage certificate type of thing. So maybe you had bought Amazon and AOL in 99, 2000. Your AOL didn't win out, but the Amazon has appreciated so much, maybe it makes a large part. But it's a buy and hold, never to sell. So you're just trying to find those things. So that approach where, once again, you wouldn't see as many stocks trading on the market. The use of tax-deferred vehicles, variable annuities, and life insurance. Whenever taxes were high, these were products that were used to try to defer those taxes, especially if you're looking at capital gains as income tax or distributions as income tax. The tax deferral is going to make the variable annuity much more tax efficient than it's going to be an investment account. And the mortality and expenses that are there for the variable annuity are going to be a cheaper way than paying the tax hit each time you make a trade.
So that'll make that much more attractive, because the mortality and expense is not going to be that much relative to the tax savings.
Right. So a lot of products that were used prior to the tax change will come back onto market as a dominant way of doing that. And then also donor advised funds. So one thing is, if you have that Amazon stock that's highly appreciated and you're making gifts to charitable organizations out of your income each year, why not give them the Amazon stock, never pay the capital gains distribution, keep your income, you got the deduction, so you get to keep more of it on a after-tax basis, and you go out and buy a different company with the remaining. Now, it requires people that are already gifting, but there are strategies that would be used. Also, these tax changes, I remember during the Bush tax cuts, they were talking about afterwards, it needs to be a permanent tax. There's never been a permanent tax change, right? The only thing that's permanent is a constant change in the tax
Exactly, that is a permanent matter.
So there's likely to be a change again of who's in power, and the tax policy will be changed. So it may be just a few years, a few terms, who knows how long, but if we start to look at the census and some of the other things that we've talked about, the move from the blue states to the red states are starting to change the makeup of Congress. Not to say that that Texas is necessarily going to elect a Republican congressman. They may add that, but for the most part, all the shift in the census has been from blue states to red states, so the congressional makeup of the House
may change
to be more Republican favored than Democrat favored. That's a very complex component, and I'm oversimplifying it, but you could see some of the things that could change the tax code before the next decade, for sure. So we've basically touched on all of these over the last few weeks on our thesis, even being bearish on international when we talked about why we were bullish on the U.S. We talked about Europe and other areas. And we've also, we need to do a segment on the move from the blue states to the red states.
Yeah, I think that'll be a good future market insight broadcast. So we're running a little bit short on time, so let's see if we can make it through these really quick.
So here, let's just jump. So interest rate, so the one thing that we didn't touch on is bonds. Interest rates continue to move up over the last month, though. We've seen a trending down movement in bonds.
Wow, well, thanks for your presentation today. It's always insightful for me, because I always seem to think that I learn more every time that we sit down and talk. But as always, our goal with these Market Insight broadcasts is to give you our view based upon data, analysis, and economic theory, so that you can be better informed and have actionable advice with regards to your hard-earned money. So we don't want to be a secret, though, with our clients and our friends out there. So what can they do to make sure
there is an arrow below us.
There's an arrow below us.
Click that arrow and send it out to your friends. While you're there, hit that like button. Especially if you like this thing, but if you didn't, go ahead and hit the like button anyways. And if you're not subscribed, please click the subscribe button so that you never miss an update, whether it's a weekly market insight where we take a deep dive to give you actionable advice so you can make informed decisions, or to get the skinny on the 3x3.
The daily 3x3. And of course, if any of you have a question about your portfolios, or if you just want to learn more about our firm, please call us at the number on your screen, and our advisors would be happy to have a confidential conversation with you. And once again, thank you so much for joining us. We truly appreciate having you as our audience and being able to give you our thoughts. Goodbye for now.